Hey guys, Cam from Investors Underground here. Welcome back to the Beginner's Trading Guide videos. This is lesson 4 of 8. If you've landed on this video and you haven't seen the previous 3 lessons, you can click this green back button here and it will take you to lesson 1. That really is where you should get started. So we set ourselves a schedule of a lesson every second Wednesday. And I've been really happy with all the content and information we've been getting through so far. Obviously, the YouTube channel isn't my #1 priority. Between trading and ensuring new members are getting great value out of their subscriptions and creating content and information that's super useful to them, sometimes the YouTube channel takes a little bit of a backseat. But I'm super happy to get back into it and try and deliver the most concise and effective lessons for you guys in these 3 trading series. If you haven't already done so, be sure to subscribe to the YouTube channel. It's free. All you have to do is click a couple of buttons and you can do so here. So a few people have been reaching out to me and also commenting in the section down below, curious about whether all of these lessons are going to cover all the content in the DVDs that we've created, or just curious about the difference between what we're doing here. So essentially the YouTube channel and these lessons are a bit of a taste of the quality of content that we put out at Investors Underground. Now, I've said this many times that you obviously can't learn an in-depth perspective of trading on a 15-minute video on YouTube. It takes me a lot of time to make these videos. However, when Nate and I put together the DVD series, it took almost a year per DVD. Each DVD is 10 hours of content, and we've ensured that every chapter is jam-packed full of information that you guys are going to need to know to be able to understand the markets and have a chance at success at day trading. So the DVD courses are the foundation. The Investors Underground membership is where you start putting it into action. You've got the chat rooms and the scans. So every day Nate puts out a watch list of what he's looking to trade the next day, 5 to 10 tickers. Then we're all up early in the morning in the chat room, revisiting that scan and seeing what's moving and what's going to be in play. Nate's calling out his positions live in the Investors Underground chat room. Then you've got your webinars and your video recaps. So the webinars we run a handful of times a month, and basically that's to answer any of your questions as members that you might have about trading, whether you're asking, hey, I didn't understand why you took this trade on Tuesday afternoon. Can you talk a little bit more about it? Or I really struggle with this part of my trading. Have you got any advice? And we go through and answer each person's question individually using audio and video to best explain it with chart examples and stuff like that. The video recaps are, short videos that Nate puts out almost every day where he talks about what he traded, what he did well, and what he thought he could have done better on. So although everything that we do is focused around group learning, that's the way that we believe people learn the best, we also like to give one-on-one attention and engagement when people need it. So whether it's reaching out before or during a webinar with a question, whether it's dropping us an email, we get back to you personally, whether it's reaching out intraday in the chat room and asking what we think of a ticker and the price action, or to review a trading plan on a long or a short setup, we're there with you every step of the way. So I just wanted to kind of clear that up before I got started. What are the differences between what we do on YouTube, what we do in the DVD courses, and with membership as well? So let's get started. What is the definition of bearish? Well, in the context of the market, a bear is somebody who believes that prices are going to go down. They're often very skeptical about market excitement and pessimistic about companies' valuations and the direction that they're going to trade. So I did a bit of a Google to work out where the word bear or bearish comes from. And according to a few sources, it comes from old school merchants who would sell bearskins before they had actually received inventory of their stock. So if they believed prices were going to go down, they'd pre-sell a bunch of stock at the current price and wait until all their inventory was delivered and then send them out. Which is kind of what short selling is, and I'll go into that in the next point. But a few other pointers on why the word bear. Well, bears attack downwards, whereas bulls attack upwards. They buck with their horns, whereas bears swipe downwards with their paws. And one thing that I kind of thought up is that bears love hunting for fish. And in poker or the market, A fish is a person who really doesn't understand what's going on. And there's an old joke at the table. If you don't know who the fish is, then you're almost certainly the fish. It's often that bears make a lot of their money through inexperienced, enthusiastic, bullish traders who are buying stocks at way too high levels and get smoked out in the process. So in the next 3 points, we're going to look at what short selling is and how it all actually works. So short selling has nothing to do with the length of time that you're going to be in a trade or a stock. Short selling is in fact borrowing stock to sell immediately, anticipating a downward move, and then buying it back to cover at a lower price and repaying the shares. So essentially you short high, you buy to cover low, and you take the profit in between. So how do you sell stock that you don't actually have or own? Your broker gives you what's called a borrow. And essentially what they'll do is look into their inventory or work with other brokerages to look into other inventories to lend you shares for a temporary amount of time so that you can sell them directly onto the market when you want to. So for example, let's say you think a stock's going to go down and it's trading at $10 and you want to short 200 shares of it. Well, once you click the button to short it, you'll sell 200 shares at $10 to the market and you'll have $2,000 in your account, but you'll owe 200 shares. Then if the price goes down by $1, you can buy them back, 200 shares at $9 a piece. It'll cost you $1,800 and you're returning the 200 shares, but keeping the difference between what you sold them for and what you paid for them to buy them back, and you keep that $200 as profit. So in the case that you might be wrong and this $10 stock goes to $11 instead of $9, well, you're going to be short 200 shares at $10 a piece. Price goes up to $11, and if you want to exit your position, you're going to have to buy them back, 200 shares at $11 a piece, which is going to cost you $2,200 versus the $2,000 that you sold them for, and you're going to lose $200 on that trade. So I get the question all the time, why would anyone lend out their shares if it looks so obvious that this stock's going to go down? Like, wouldn't the longs want to sell it instead of letting a short borrow it and short it? And I guess that's all got to do with time frames. You know, someone might have 1,000 shares of Apple stock that they've had for the last 10 years, and they're going to have it for the next 5 years, regardless of what the price does. And you might short 200 shares out of their inventory, and Apple might go down a couple of bucks and you make $400 on the trade, cover it up and return the shares. They don't even really know that it's happened. And 3 years later, when they're ready to sell, that little $2 dip in the price had nothing to do with the overall trend. And different sized brokers are going to have different kinds of clientele and different sorts of inventory. So some brokers may have borrows to be able to short a stock and other brokers may not. So often active day traders will have multiple accounts so that they're going to be able to borrow shares when they want to short them and have availability when they actually want it. Well, what happens when you want to short something and it's not easy to borrow through any of your brokerages? Well, in that case, you've got something called a locate. It's a plugin through your platform that goes through a locating service that pings out to the street to see if any other brokers have it available. And what they'll do is they'll reserve the shares that you want to short for that day, and it costs you a small fee. So if you wanted to short 1,000 shares of XYZ, but none of your brokerage accounts had it available, you could request to have it located, and it might cost 1 or 2 cents a share, so $10 or $20 to reserve them for the day. So I guess that leads us to the point of what do we like to trade short and why do we like to trade it? So we like to trade NASDAQ and NYSE stocks, and that's no exception on the short side. And I get the question often, what about NASDAQs versus OTCs? A lot of people come into trading, especially in this segment, thinking that shorting pump and dumps is the best way to get rich in the market. And while shorting pump and dumps and OTCs may have been a viable strategy in the years gone by, Nasdaqs have really been the place that we focused on and made money from over the last handful of years. And I'll go into why a little later in the slide, but the key reasons why we love Nasdaqs is they've got the most liquidity and often the biggest range. The patterns and the setups are the most reliable, and we focus on a handful of them as we're trading intraday. But I guess the reason that everyone is starting to gravitate towards momentum and away from OTCs and pump and dumps and shorting penny stocks is because around 2 or 3 years ago, the SEC started intervening in pump and dumps, halting the stocks and really spooking all the players who would normally trade them with size and provide the liquidity so that you could get in and out of those stocks with much more ease than you can today. And this can be a bit of a snowball effect because if there's no one trading them, then they're not liquid. If they're not liquid, then they're usually not easy to borrow. And if no one's really interested in them, then they don't really get any momentum or range. So I believe that the OTC market is a little bit of a walking zombie. Nothing much is going on there. And I don't believe it presents the opportunities that it did 3 or 4 years ago when some of the big name pumpers were running big promotions back in the day. So let's have a look at the first bearish chart setup. Lower highs. And as with any trading setup, the daily and the intraday chart are key. You know, sometimes I have people hit me up and they're like, hey Cam, look at this chart making lower highs, but there's really no range on the chart on the daily and it's just kind of bouncing around, and sure, you can draw a line across the highs and it looks like the highs are becoming lower, but it really is meaningless. So what we're looking for from the lower highs chart is a meaningful shift of momentum, a snap of a key level, and sometimes volume confirmation really helps you keep conviction in the trade. And the idea is to cover into washouts and potentially re-short bounces. And I know you guys love my drawing skills, so I'm going to give it a go here and see if I can show you a few examples. So let's say there's a stock that you've been watching that's had a pretty strong morning move and maybe did a little bit of an ABCD pattern and started moving upward. And you're looking at this because it really hasn't pulled back much, and you think there's an opportunity to take a short on it when the momentum shifts. Well, how do you enter a trade like this and manage your risk and look for that shift of momentum and profit taking that's going to give you a fader? Well, the first thing you need to see is that it isn't going up anymore. So potentially it's starting to go sideways, and put in some key levels where you know if it snaps there that there'll be some profit taking and people will feel like the run is over. So on this chart here, where are the key levels? Well, I'd say there's a pretty key level here and also a pretty key level here. So what we're kind of looking for from this chart is a bit of a snap of this level, and that might be a good spot to start in. Potentially a retest up to there, and you can see that your risk may be on this previous high, or if you wanted to give it a little more space, the high of the day. But essentially, if it starts perking up and holding, then you'd probably want to be out of this trade because then it's kind of turning into an ABCD pattern. And the idea is that as it's testing this, it will break beneath it, and during that crack, you're going to get a decent size washout, and you're going to have covers waiting to take the trade and lock in profits there, getting paid out a positive ratio on your risk. One other thing that I particularly like to see is during this washout, I like to see some very heavy volume. And basically what that tells me is if you get a big wash and some really heavy volume, then there is actual panic in the air and people are looking to get out of these things. Whereas if you have a little crack under support, heavy volume, but it doesn't actually wash out, it means that someone might be there supporting it and it might perk back up and try and push for the high of day. So I'm really trying to watch what happens under these levels to give me an indication of how long I'm going to try and stick around in this trade. So there's a particular time that works really well for these lower highs / faders. And that's often later in the day, but to really be looking out for a late day fader, I want to be monitoring an overextended kind of chart between 2:30 p.m. and 3:30 p.m. market time. And essentially what we're looking for is a bunch of tired longs who potentially don't want to hold overnight and want to lock in some profits. But they haven't really been given much of a sign to sell throughout the day because the momentum never shifted and the chart really never curved over. So during this 2:30 to 3:30 kind of PM time frame, if you start seeing that top get put in on a chart that really hasn't had much of a pullback or any reason for longs to get out of it, and the chart's making lower highs and testing support levels and looks like it's going to crack, that's a really great time to get short on some of these momentum flyers and stocks that have been strong previously in the day. So before we move on to some more shorting setups and bearish patterns, I thought it'd be pretty important to go over the concept of what a squeeze is. And whenever you're on StockTwits or Twitter or some of the other trading websites, you'll see people proclaiming every single stock that's up as a squeeze. Just because something's up 100% or 150% on the day doesn't mean it's actually squeezing shorts. It might just be that longs are very enthusiastic to get into it. So it's my opinion that something is only really technically a squeeze if the chart has actually trapped bears in it. So let's say a chart is going up on hardly any volume and it does that kind of move. Well, I wouldn't really call this a squeeze because where are the trapped shorts? If it's just kind of gapped up on air, then no one's really stuck in this. Whereas if you look at a chart that maybe plays out something like this and goes straight up, puts in a lower high, and kind of dips below that previous support, comes straight back up and starts to go, well, you can tell that people may have been shorting this break thinking a retracement down to here, when in fact everyone who shorted got soaked up and taken to the high of the day. So I wouldn't call this move to this move a squeeze because if it's on low volume, then who's really getting squeezed? But if you see a bunch of volume go down here and it all gets soaked up and then suddenly it perks up and it never really lets the shorts out and makes the high of day, well, you know that all these people are getting squeezed out into this area here and having to cover up. So this can happen on intraday and also daily charts. So let's have a look what this might look like as it plays out on a daily chart rather than an intraday kind of setup. We can see this ticker, BSPM, ran on this day from around $1.40 all the way up to $6. Came back in, consolidated for a bit. Now, if you think about where the players might be in this, people are calling this a junk stock and people are calling for this to come back down to where it was. So maybe people are short, $2.80 and maybe they added at $3.40 and, added a third time at $4.20 thinking that they're going to hold this until it goes back down to $1.40 or $1.60. Well, during these days of consolidation, they may have been, around break even, but they're still waiting for that fade. And then suddenly on this day, it starts running. And as it breaks out of this area here, all of these people who are holding for the fade get squeezed out. It runs all the way to $6 and then it comes back in to $4.80. So like I said earlier, has to be a chart that has trapped shorts in it. And quite commonly, there isn't a lot of real inventory around. And I'm going to go into that point in a couple of slides when we go over float rotation. But commonly a squeeze happens on a chart that's very crowded on the short side. So if you see a lot of people touting this stock to go down, then it can be full of shorts. And sometimes the tiniest little perk can cause panic and fuel the next move up. And this is kind of a bit of a snowball effect where stock goes up, traps a bunch of shorts, it goes sideways for a little while and never comes down, perks up off support, those shorts cover up, fuels the next move up, then they get stuck, it goes sideways, it perks off support, so on and so forth. Wow, we're really getting through a lot in this video. If you've been enjoying the lesson so far, do me a favor and give the video a thumbs up. It helps get me pumped to continue to make more videos for you guys. So the parabolic short is really not a trade for beginners, and I'm going to say that this trade is probably the biggest account killer for new traders that jump into this trade without really knowing what they're doing and without having the right approach to risk or understanding when is a time to bail on it if you're totally wrong. So for me to consider a stock parabolic, it can't only just be up. It has to be experiencing an abnormal move to the upside. So what do I mean by abnormal? Well, it's an accelerated move relative to previous price action. So let's have a look at what this might look like, painting it out for you guys. So the stock's trending, and let's say it's even up 100% here. And then it has a bit of a move, dips, and then it starts to really take off. This is what I consider to be the parabolic move. Because you can see in this area through here, it's trending, but it's on a kind of trend line. And then it breaks off the trend line and breaks off again and really accelerates to the upside. So how are you supposed to trade this? How are you supposed to make money from it? Well, it's a reactionary trade based off a kind of blow off top concept where we're putting together some of the previous things you've learned about shorts and them getting stuck and the short squeeze and panic covers and all that stuff. This is what usually creates this big move to the upside. So as big volume hits here and it really has that blow off top, the stock kind of reaches a point of exhaustion where there are no more scared shorts to cover and there's no one really left to chase it long, and there's been a big wave of selling from the longs. There really just isn't anyone to buy it up anymore at these specific levels. So the riskier trade on this parabolic short would be to try and time it so that you can see the volume coming off, you can see this blow off top, and you're shorting here and you're shorting here, anticipating a pullback to some kind of normalcy before making a decision whether it's going to go up or down from there. So you'd be looking to cover into the immediate pullbacks because really this chart hasn't shown which intention it's going to go for in the medium term after it has its pullback to kind of normalize that blow off top a little. So I mentioned that was the riskier trade on the parabolic short. The less risky trade kind of combines the lower high lesson that we did earlier, where this might put in a lower high here, retest a little, and make a pullback. And you can short into this area here, and maybe as it's testing here, and your covers are in this washout over here. So you can see the second option in terms of the way to approach this trade has a defined risk on this area here, and you're anticipating a crack of this level over here. So maybe you're risking from, let's say, your average entry is over here. So you're risking here and your potential washout is twice your risk. That would be a pretty ideal trade on this. So as I mentioned, a lot of this move can be caused by scared shorts and panic. People covering up their short position and buying at market to do so. Sometimes they're being forced by their broker if they're running out of money in their account and they're getting a margin call. It has to show some unnatural price action and really have that blow off top with high volume to confirm that pretty much all of the shorts who were still on this are squeezed out and it can fall without it being crowded once it blows off the top. So more often than not, these big parabolic moves and these big blow-off tops happen on stocks that we consider and also most other people consider to be junk. Junk is looking at the ticker's fundamentals, just having a quick glance and seeing basically if it's a real company or not. And you can look at a few key metrics to see if it's total BS or if they actually have some kind of operation in place. So if you look at what kind of revenue they bring in every year, how much of that is actual income, what's their cash burn rate, and then you look at the size of their market cap. And if the numbers don't really add up, then it's considered junk. I'm going to have a look at some of these numbers on the next slide under float rotation. But sometimes the case is that the worse the numbers, the bigger the thing can run. And this plays into the concept of early shorts getting in there, not believing it can go any further, where they're so focused on the numbers and the fundamentals that they're not reading the price action and the way that the chart's trading out. And they're not mindful that sometimes markets can stay irrational longer than they can stay solvent. Stocks can run from $1 to $3 to $5 and even 10. And a big portion of the time, these junk stocks come back to where they started running from. But it really is a case of timing is everything. And if you do have a bearish sentiment on one of these companies because you do think it's junk, you really need to watch the price action and not get married to the trade. Because although you might be right in the long term, in the short term, there's a possibility that you're going to blow up your account trying. And for this last point here, I've got that you need to be careful of float rotation. So we're going to cover exactly what that is on the next slide. So before we have a look at the pointers on float rotation, I want to go through some of those key numbers that I was talking about in the previous point on this stock MGT. And MGT over the last few weeks has been an enormous runner. Started at 20 cents and went to $2 and then ran all the way up to $5.50 before coming back in again to around $2.50. So at first glance, let's see if this is a real company. Well, every year they sell 100 grand worth of stuff. To do so, they lose $3.9 million. They've got 15 employees and the company is supposedly worth around $75 million. At first glance, this certainly does seem to tick all the boxes of pure junk. So how does this all play into float rotation? Well, to help you guys understand it, we're going to look at what the float is versus what outstanding shares are. We can see on this particular stock, the shares outstanding is 23.61 million and the float is 20.49. The outstanding is the total number of shares in existence and the float is how many shares can be traded freely at the market. So if we inspect this chart and have a look, before momentum and volume really starts to step in and before this whole run takes place, this stock was trading between 30 and 40 cents on this day here. And the next day it gaps up on some kind of news and is essentially a doubler, sells off for most of the day. And you can see that 10 million shares were traded here. Now, if you think there are 20 million shares that can be traded in the public, 10 million shares is a decent chunk of that. But between these 2 days together, where it's that kind of sideways consolidation, you've got 18 million on this day and 10 million on this day. So I'm not saying that everybody from down here who owned them is out, but we've traded 1.5 times the float in between these 2 days of consolidation. Then if you have a look at this next day, we've got 30 million shares just in one day alone, 63 million in this day, and 34 million in this day. So the kind of concept of float rotation is there are people who were in it down at 30 cents who may have sold it at 60 for the people who wanted to take it to $1. So while these guys doubled their money, they're not really in it when it comes up to this level. The people who own it at 70 cents now want to take it to $1.40 and they exchange hands at this level and that's what causes all this volume. And all the people buying it in here are people who are buying it for $1.50 thinking this is going to go to 5 or 10. And they're selling it into these big candles where you've got 80 million shares trading there and 110 million shares trading there. So between these 2 days, we're looking at 10 times the total float of this company being traded. It no longer really matters what the price per share is in the short term. It matters more about where people are in from and how many times has this changed hands since the original holders at 40 cents. People are thinking, oh, 40 cents to $4 is just too big a move. It's 10 times where it was before. But the people who had it at 40 cents maybe sold it at 80 cents. Then the people who had it at 80 cents maybe sold it at $1.60. And the people who had it at $1.60 maybe sold it at $3.20. Each of them are taking a doubler. And each of those moves by themselves aren't so outrageous. But then when you look at 40 cents to $4, you might think, hey, it's too far. Well, no one from 40 cents is actually going to be holding it, so it's not the right way to look at things. And you can see, especially on these 2 days here, these two big green candles are probably squeezing out all the shorts who tried to short it down here, thinking that 40 cents to $1.75 was too big a move. And as you can see, momentum really got hold of this. It went all the way to $5.50, and then gravity takes care of it on this big selling day here. So to reiterate those points, focus on the size of the float. A low float plus high volume equals rotation. Usually these are very liquid, but there's no real inventory. So try and ignore the price per share and really focus on the price action. And remember, there's no such thing as quote unquote too far. So I want to cover a couple more points and then we'll wrap it up for the day. But T+3 and buy-ins. So when you borrow a stock, at some stage you've got to give it back. And many brokers will give you T+3 before having to buy in or cover your shares. And T+3 is the time you get to settle the funds. So if you short something on Monday, then it's likely that you're going to have until Thursday to cover it up. And either on your own accord, you can cover it up, or sometimes your broker will give you a heads up that they're going to have to buy you in. So that can be something to keep in mind if you're planning on swing shorting. However, one thing I've noticed is if the chart's holding up after a big run, so let's say it ran big on Monday and Tuesday and Wednesday it held up, Thursday it might go for a secondary squeeze because everybody who shorted it on the big run on Monday has to buy in their shares and it can cause it to run again. And last but not least, risks and margin. So everyone says, on the short side, you've got unlimited losses. And although technically that is true, if you're trading short intraday, just the same way if you're trading long. But when you look from an overnight perspective, your risk is unlimited, because if you're long a stock at $2 and it goes to 0, well, you'll lose all your money. But if you're short a stock at $2 and it goes to 10, well, you're probably going to owe the brokerage some cash. And one thing I see that sometimes I think newer traders don't understand is that averaging into a losing short trade is more expensive in terms of buying power and equity requirement than averaging it into a losing long trade. And just to give you a quick example of that, if you're long 1,000 shares of a stock at $2 and it goes down to $1 and you want to add another 1,000 shares, it's going to be cheaper to average in, and your equity requirement and buying power isn't going to be as affected as if you're short a stock at $2, it goes to $3 and you want to double down your position. Well, because 3 is a bigger number than 2, you can get into a trickier situation in terms of your equity requirement and risk a margin call on that kind of position if it keeps going against you. Well, we ran a little over time in this lesson, but I'm super happy with all the information we got through. If you guys have been learning a lot from these free videos, you can probably only imagine how great the content is for our paying subscribers. Really, while I love making videos for the YouTube channel for you guys for free, where all of us spend the majority of our energy is trading and ensuring the right lessons are there for members and subscribers of the Investors Underground community. Pricing doesn't need to be prohibitive. I can sort you guys out with a deal. Drop me an email. It's cam@investorsunderground.com. and I'll send you a reply personally. The next lesson, we're going to be going over how to use a trading platform and what kind of requirements you might be interested in getting in terms of computer hardware to trade. This has been Cam for Investors Underground. Good luck with your trading.